evening, Stonegate audience. I hope everyone out there is doing great tonight. I know we had a great but busy weekend here, and I hope everyone out there is saying the same. So last week I finished up kind of a three-week series on math and note investing, and I didn't get anything wrong, but I just wanted to go into a little bit more detail about one of the things that I talked about last week, that was yield. It just kind of played around in my head for a couple of days, and I realized I wanted to go into a little bit more detail about the differences between return on investment and yield. A lot of people kind of get those two things mixed up, and I know I have even myself in the past. So I just thought I'd go into a little bit of detail here. And what happened was I realized just there was more to this than I originally thought. When I was doing some rehearsing and such, I realized this would either be a really long video or that I'd have to leave out a bunch of details. So instead, I'm just breaking it up into two videos here for you. So return on investment, ROI, equals net profit divided by the total investment. So a couple things about that. Believe it or not, return on investment, a lot of people talk about it going forward. Technically speaking, return on investment kind of looks back in time. You look at a return on investment when everything is said and done and all resolved. And the other thing about it, you want to make sure that you adjust for the time frame that you got that return on investment in. And I'll talk about that in a minute. So one real simple way to go about it is if I sell a house for $120,000, and I will come back to that number in a minute about just how exactly I got that. And then the total expenses for the house are $100,000, and again, I'm going to come back to that. I end up with 120 divided by 100,000. That equals a 20% return on investment. But again, you want to remember that total profit, that net profit, you want to make sure that you're including everything into that. So for example, if it was a house that I was selling and maybe the buyers actually agreed to buy it for $125,000, but then they say, well, you know, I want $3,000 in closing costs, and then you need to replace the carpet, and that's another $2,000. That kind of bites right into my net profit right off the bat. So what I would do is I would just take that off of there. So I would end up then again with my example of $120,000 profit, okay? And you want to make sure when you look at your total expenses that you really take into account all of your total expenses. You want to be as specific as you possibly can. That might include things like insurance, okay? Taxes. If you had the house for a year, then you probably had to pay taxes on it. Any types of repairs that you had to make in order to get the house ready for sale. Even myself, I have accounted for a lockbox. Again, if you really want to be specific, and that's kind of the key to a lot of things is attention to detail, you just want to make sure you account for all of your expenses. And the other thing, like I talked about a little bit earlier, is you also want to make sure that you're adjusting for the time frame. Okay, so just to use this exact same example here. Say, you know, I bought a non-performing note and then brought it back, but say it was in a longer foreclosure state, like, well, 2 years would probably be a long time for even, or kind of a short time, excuse me, for New York or New Jersey, but say it took a total of 2 years, okay? My total return would be 20%, but it took me a full 2 years to get that. So if I broke it down onto an annualized basis, I would want to cut that in half. So then my annualized return on investment would only be 10%. That's why a lot of people will just avoid altogether, you know, buying a note or an investment in a state like New York or New Jersey, because it takes so much longer to potentially get the house back in event of a foreclosure. So what you want to do is, if you're going to buy an estate like that, just try to take this into account ahead of time and really think about, okay, what if the worst case scenario happens if it takes me 2 years or 3 years? You want to build that type of information into your bids when you make it. Now, say the opposite is true. Say that this same house, you just you took it out of New York and you put it on a trailer, you took it down to Texas or whatever. Or maybe you just have magical sorcery powers and it's just in Texas now. One way or another, say that you got that house back and you got it sold in only 6 months, okay? So now we've got that time frame working with us. It's working in our favor now. So before I told you about 20% is what you would be looking at in that deal. If you shorten it to 6 months, you're going to double your return. So it's going to get up to right around 40%. And if you really want to be specific, I mean, you can even get into it, well, this took 11 months, so it wouldn't be quite doubled. Or excuse me, this took 7 months, so it wouldn't be quite doubled, but it would still be better than 20%. You can get that specific if you want. That's just beyond the reach of this particular example here. But so the other thing was, what I will do next week then is talk a little bit more about yield, which is a forward-looking projection. So thank you very much, everybody that joined me here tonight. Ben, Alex, Patty, Corey, thank you very much, everyone that joined me live. I hope this was helpful. And until next week, that is how you climb the hill. Thank you very much. Have a good night, everybody. Bye-bye.